We've analyzed over 132 individual investments and portfolios, and in this video today, I'm going to share with you an interesting study where we ask the question, what is the best investment for short-term income needs? I think you're going to find some interesting ideas that you can pull and apply to your retirement within this video. Now, before we jump in, this is going to be a little bit longer of a video and is going to be fairly data heavy. Now, in the description below, I have the timestamps if you'd like to jump around, but know that this video is going to build slowly, and so if you jump ahead, you may be missing some important context. But let's get into it. Now, we face a difficult problem in retirement. We have different time horizons on the income that we need. For instance, we're going to need money over the next year for income, 2 years from now, 5 years from now, even 10 and 20 years from now, depending on where we're at in retirement. And we have these competing factors that have a different weight at each of those given time horizons. So on one instance, we have this downward pressure called inflation. Now, outside of the last 2 years, inflation has been a little bit of a stealth tax that many of us don't often see. Now, we're very acutely aware of it right now as we see rising costs. For instance, if you would have kept the income that you need this year in cash over the last year, you would have lost pretty significantly due to inflation. And so we know that over different time horizons, we need to invest that money in order to grow beyond inflation. But anytime that we grow our money, we now enter into some risk as well. We enter into the risk of losing our money. And so how do we balance these competing factors over these time horizons? In this video, we're going to develop an approach to balance these risks. And hopefully by the end of the video, you're going to gain a new perspective on how we can start to navigate these different time horizons. We're going to be showing a lot of charts that look like this. Now, I'm first going to show this example here to explain what this chart is and how you read this chart. So what this chart shows is the amount of money we would need to invest today in order to have an inflation-adjusted $50,000 in 10 years. Now, because this video is focused on the short term, we're going to be looking at time horizons far shorter than 10 years, but nonetheless, let's use this as an example. Now, in this chart, we are looking at what we would need to invest if we were putting that money all into stocks. And as you can see, there's quite a bit of variability along these given time horizons. Now, we're going to look at the average amount you would need to put in. We're going to look at the maximum amount and then the minimum amount. Know that the lower the number, the better off that investment would be. For instance, if you would have put $9,430, this green line, into stocks in 1949, in 10 years' time, you would have had $50,000 of inflation-adjusted income. Now, to look at the other extreme, we would have had to put $79,975 into stocks in 1966 to have that same inflation-adjusted $50,000. And so we see a lot of variability here, even on a longer time horizon like 10 years. Now, when we're talking on a shorter term time horizon, most people would think we should just put that money in cash. After all, if we need it in, let's say, 1 year, we don't want too much variability. And yes, inflation may weigh down our performance, but at the end of the day, that's better than experiencing significant losses due to putting that money at risk. And when we look at navigating the extremes, in my opinion, the extremes would be putting that money all in cash or putting that money all in stocks. Now, if we just look at these two charts in both of these extremes, it might be a little bit difficult to make heads or tails of which is ultimately better. For instance, we see that cash has far less variability in the given returns. This is to be expected. We're not earning a large yield on cash really at any point in history. Stocks, on the other hand, have significant variability, and in some of those given situations, you'd be able to put in far less if you needed $50,000 of inflation-adjusted income 1 year from now. Now, if we just try to look at an average in order to gain some heads or tails, it would look that stocks are actually the better alternative here. On average, if we put $47,674 into stocks, in 1 year's time, we would have an inflation-adjusted $50,000. In terms of cash, we would need to put $49,695 into cash on average. And so if we're just looking at the averages, it looks as though stocks would be the better short-term solution. But regardless of what the averages say, this seems a little bit crazy. And I agree. The conclusion from this video is not throw all of your money in stocks and simply hope and pray that you enter one of those favorable market environments. Instead, we need to offer some different risk solutions in order to navigate some of that variability. Now, I have a few creative solutions that we can use for the sake of this study. Let's say in 1 year, we needed to put $47,000 into a given investment to have that $50,000 of inflation-adjusted income a year from now. In the next year we look at, we would have needed to put in $52,000 following year, we would have needed to put in $49,500. So if we look at the average between these 3 years, we would have had an average of $49,500. The problem here with using a simple average is if the positive variability outweighs the negative variability, it doesn't matter what the overall variability is, we will have a lower average. Instead, what we can do is we can penalize the downside. And so we can weigh the downside at a rate higher than what we would weigh the upside. For instance, in this scenario, and this is a little bit more of an arbitrary figure that I chose, we're going to penalize the downside by 3x. We would see our adjusted average is now $50,833. And so we're attempting to penalize the downside. The second solution that I have is something called a Sortino ratio. Now, this is a well-known investment metric, and essentially what it does is we take the annual growth rate that we expect. We're going to subtract out inflation so that it's an inflation-adjusted growth rate, and then we're going to divide by the downside volatility. And so, for instance, any variability that we have to the downside, we want to further penalize. And we're only looking at the downside variability because ultimately we don't mind upside variability. It's this downside variability that we care most about. So if we need to put in more than $50,000 to have $50,000 1 year from now, that's ultimately what we want to penalize. And so the higher the Sortino ratio, the better. So now when we go back to these two extremes and we look at cash versus investing in the stock market for money we need 1 year from now, we see that these two risk metrics offer a little bit more data for us to analyze. So the stock Sortino ratio is a little bit higher, but we can see the adjusted average, we would have to put in far more with this adjusted average into stocks in order to have that $50,000 of inflation adjusted income 1 year from now. And so now it looks as though it caters a little bit more to putting money in cash, which is exactly what our initial thoughts would be. But again, we're not just going to be looking at the two extremes. There's likely solutions in the middle that end up being better than both of these extremes. Now, before going into all of the data around individual investments, I want to first introduce an alternative that may be a new investment for some of you. Now, my goal here is to try to analyze as many investments as possible, which is why we're introducing this new type of asset. Now, I describe this as a market-linked asset. I'll talk a little bit about how there are various ways that you can duplicate this risk-return profile, but here's essentially how this risk-return profile works. So you're tied to a given index. For this example, we're going to use the S&P 500 index with no dividends, and we're going to use a 40% upside rate with a 0% downside. So essentially what this means is, let's say the market first grows 10% in a given year. Well, you get 40% of the upside, 4%. The next year the market grows 28%. You get 40% of the upside, 11.2%. The following year the market loses 40% during a bear market. You are capped at a 0% downside risk. And so from a short-term income need, this looks like an interesting risk-return profile. We have that high upside variability, but that downside variability is capped to inflation during those losing years. Now, I just want to look at this risk-return profile big picture. I'm not going to comment on the best way to duplicate this profile within your retirement. No, there are multiple ways though. There are certain insurance and annuity contracts that you can use. Now, be very careful using some of those given products, but you could also duplicate this yourself theoretically. Let's take this investment. Let's take cash, stocks, and everything in between, and let's rank them based on needing money 1 year from now in retirement. We can also then expand this to 2 years, 5 years, and so on. And we're going to look at all of these individual assets underneath these risk measures we talked about before. And what you're going to see are potentially some surprising things. So first off, what I want to point out is we have limited data on some of these given assets. I've tried to note that on the screen and also know that that will affect some of these ratios a little bit. We can take stocks, 10-year treasury, real estate, cash, all of that we can take all the way back with a significant amount of data. However, with corporate bonds as well as with TIPS, Treasury inflation protected securities, we have far less availability in terms of data. For instance, if we take something like TIPS, those inflation adjusted bonds, we only have data back to 2001 with these given securities. If we took all of these individual investments and ran them back to 2001, we'd notice the numbers change quite a bit. Now, I wanted to make sure I included these because these are viable options, but just know that we don't have the length of data. And so just know that there is an asterisk on anything within this red box here. But nonetheless, we can see some pretty interesting things by looking at these two risk measures. For instance, gold, global stocks, as well as intermediate bonds like a 10-year treasury, all rank in the lowest quartile of all of the individual investments under both risk metrics. Real estate ranks low on Sortino ratio, but then middle of the road in terms of that adjusted average. US stocks rank high on Sortino ratio, but rank a little bit lower in terms of that adjusted average, both of these due to the high volatility within both of these given investments. Then we'll notice that most shorter term bonds, as well as the market linked asset, tend to rank a little bit higher under both risk measures. Now, this shouldn't be that surprising because when we penalize the downside, all of a sudden we start to see that something with a smaller yield but protects your downside starts to rank a little bit higher in terms of needing money within a shorter term time horizon. Now, as we start to extend these out in terms of a 2-year, 3-year, 5-year, 10-year time horizon, we'll start to see some of these numbers shift a little bit. Now, I want to pause here and make a note because we're going to be coming back to this, that on an individual investment basis, we see that it's quite difficult to get a Sortino ratio higher than 1 and an adjusted average lower than $50,000. Now, keep this in mind because as we start to develop around this idea, we're going to be coming back to this baseline. Now, although some of the data that we've shown might be interesting, I want you to, in a sense, almost forget most of it because we've kind of been operating with a hand tied behind our back thus far. We've been looking at just individual investments over a very specific time horizon. And this is kind of akin to if we played basketball and you were only allowed to shoot or score when you were inside of the paint. Now, I'm sure it doesn't look like it because the camera can hide some of these given things, but I'm 6'7", 6'8". And so in that given scenario, if I was defending somebody that could only shoot inside the paint, well, I would just plant it right inside the paint and most people wouldn't have that much success. In a similar idea, if you were only able to shoot 3-pointers, well then who's ever defending you should just simply sit at the 3-point line and not worry about you trying to blow past them and score a layup. And so when we look at investing, we shouldn't just look at individual investments. We should look at how these investments combine together to build a portfolio. So the good news here, when we combine investments into a portfolio, it improves outcomes. We use the benefits and drawbacks of each individual investment, and we hope that they offset one another. So on the screen, we have individual investments of US stock returns as well as intermediate bond returns. And we also have the Sortino as well as adjusted average of both of these individual investments under that 1-year time horizon. And what you'll see is the Sortino ratio is less than 1 and the adjusted averages are over $50,000. What if we took these two individual investments and combined them together at varying rates? Does this improve outcomes? And the good news is it does. And so on the screen, you'll see a combination of these two individual investments into a portfolio. On the x-axis, we're looking at the percentage that you would have in stocks. And what we'll find with both the Sortino ratio as well as the adjusted average, that if we have about 40% invested in stocks with 60% invested in intermediate bonds, this delivers the best outcomes historically. We now have a Sortino ratio above 1, and we have a adjusted average below $50,000. And so this is what I mean where you can forget most of the data when it comes to individual investments. It seems that portfolios and combinations of these individual investments ends up improving outcomes. Now, this shouldn't be that surprising, but before looking at the portfolio level data, let's introduce another alternative investment. I'm going to describe this investment as long volatility, meaning that we're basically going to invest in volatility. And so when we think about diversification, an important principle of diversification is we need non or inverse correlation. If we have two investments that behave very similarly together, they provide no diversification benefit. We need investments that behave dissimilar to one another to provide any diversification benefits. Well, long volatility is essentially investing in volatility. We know that volatility spikes during market crashes. And so it's actually inversely correlated to stock market performance and can be a great way to hedge stock market volatility. So once again, I'm not going to comment on the best way to allocate to long volatility. Just know that there are multiple ways, from using exchange-traded funds to using options to even using hedge funds or separately managed accounts, depending on your capability as an investor. For the sake of this analysis, we're going to be using the Eureka Long Volatility Index to duplicate any returns from investing in long volatility. So let's look at a couple different combinations of adding individual investments together in a portfolio. Now we're going to be using everything from bonds to stocks to market-linked assets to long volatility to things like gold, and combining them together at different percentages. Now, in the analysis of these portfolios, we ran a ton of different combinations. I'm just going to show a few on the screen right now. We're going to also look at the Sortino ratio as well as that adjusted average. And what you're going to see is, once again, I've indicated and asterisked out the investments that have a shorter term time horizon. And what's interesting is what you'll see is across the board, we see higher Sortino ratios and lower adjusted averages for gaining that $50,000 in 1 year at the portfolio level. This is a lot different than we saw at the individual asset level. For instance, all but one Sortino ratio is at least above 1.2. All adjusted averages outside of one individual portfolio have a lower adjusted average than $50,000. And so this is very intriguing when we start to talk about allocating at different time horizons. Many investors are simply putting all of their money in cash if they need money 1 year from now. But as we see, having a more diversified portfolio actually delivers better results under numerous metrics that we look at. And so within this study that I'm sharing with you, I tried to limit some of the data. After all, we could be going through pages and pages of looking at a bunch of different graphs and charts. Now, if some of you are interested in me expanding on this given data, please let me know. But I want to share with you 4 important findings from this study that we ran. The first one is cash is not king on a short time horizon. Now again, many investors are allocating to cash, but as we see again, a more diversified portfolio delivers better outcomes. Number 2, we see that portfolios deliver better outcomes than individual investments on all short and intermediate term time horizons. Now, this shouldn't be surprising because when we develop a portfolio together, we are taking benefits and drawbacks of each individual investment and trying to offset those by benefits and drawbacks of other individual investments. Thus, we gain the power of diversification within our portfolio. Number 3, I think, is probably one of the most surprising for many investors watching this video. Many investors would never think about adding stocks into a short-term portfolio. But as we see, adding stocks on a smaller basis and hedging the drawdown of those given stocks delivers some of the best outcomes. When we add long volatility to a portfolio, or we add things like gold, market-linked assets, or bonds into a portfolio, we find that holding a little bit of equity within inside of that short-term portfolio actually delivers better outcomes. This was certainly surprising to me, and I'm guessing was surprising for many of you watching this video. And then finally, number 4, and this is more of an asterisk on this entire study, is the solution that's best for your specific situation will vary from investor to investor. For instance, if you're a complete DIY investor, you may want to take some ideas from this presentation, like investing in a portfolio for different time horizon needs, but you may not be able to allocate to things like volatility and market-linked assets in a prudent enough way. And so it may limit some of your options. Other investors may want to raise that downside adjustment in terms of that adjusted average metric in order to penalize the downside even further. Others that might be a little bit more risk tolerant may want to actually decrease that downside adjustment. And so know that there isn't a one-size-fits-all solution for everyone watching this video. But nonetheless, I think there's some important themes that you can gain from this study. And one of those given ideas is taking this idea a little bit further. So we were primarily just focusing on money that we need 1 year from now. Notice that if we went with the 2-year time horizon, the numbers wouldn't change that drastically. But when we go out to the 5, 10, and 20-year time horizon, the numbers and the optimal assets or portfolio would change quite drastically. And so what we can do is we can take this given idea that we presented here today, and we can look at the income that you need at various time horizons. We can then backwards engineer our portfolio and gain the optimal allocation based on the income within those time horizons. This is what I would call a liquidity schedule. We're looking at the income we need, we're looking at the optimal solutions based on the time horizon that we need that income, and we're optimizing our portfolio that way, rather than just taking a classic 60-40 portfolio or taking some other variation of a number of portfolios and kind of just picking it out of a hat. Now, in retirement, when we have that income need, by definition, this should improve outcomes in most scenarios. Now, anytime we share a data-heavy study like this, I love to get some feedback in the comments below. What did you like? What didn't you like? Do you have a different perspective that might add to this given discussion? If you like this data-driven approach we took to portfolio analysis, you're going to love the data-driven approach we took to Roth conversion timing in this video right here, where we lay out the best time to perform a Roth conversion as you move through retirement. Thanks for watching, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.